Good afternoon, everyone. It is April 3rd, 2025. If you can believe it, here we are, the beginning of April. I'm Jennifer Schurter, and this is another episode of Real Estate Recess coming at you right now. Have a lot of stuff to talk about. Took a week off for spring break last week. Hope all of you out there, if you are spring breakers, had a good time, taking some time off, enjoyed your children if you have them, or maybe you just spring break for the fun of it, even without kids. Excuse me. So let's dig into what we're going to talk about today. But before we do that, can you do me a quick favor? I would love it if you would take a look at that subscribe button here on YouTube. If you could subscribe to my channel, if you would maybe hit the bell to be notified when I have new content, because if you like real estate related content, you like tracking what's going on in the market, or you just like to put things on in the background and listen like I do, then I would love to have you be part of my community here on YouTube at my channel, Living in Portland Suburbs. I love to dig into real estate information and topics and talk about them and bring you my viewpoints on it. So please do, and leave me a comment. Say, hey, would love to have you interact with me during this show today. So on the agenda, there's a few things I wanted to touch on today that I think are pretty interesting. We're going to talk about some articles from a publication called Housing Wire. They're a real estate authority when it comes to news and information and data. There's some really interesting things going on, including we'll do a market update according to the national data, because I think it's really interesting to know the overarching trends of what's happening in the world of real estate right now, because yes, it does trickle down to Oregon in some way. What I will remind you of as we're going into these talks about the national information is that housing by nature, or the real estate markets, are hyper local. That's just how it is. So we can't compare a tiny town like Hubbard. We can't compare that with a Lake Oswego. Totally different market conditions, different area. So just be mindful of that some parts of the state might be hot. Beaverton right now, man, I've got clients out there and we are shopping and writing offers, and we're seeing multiple offer situations, and spring market is definitely heating up. So for what that's worth, quick disclaimer about that in regards to data and what's going on a national level. So we'll talk about mortgages and how, according to Housing Wire, they might actually be the sunny spot in the economy right now and what that means. So we'll take a look at that article. There's some charts and graphs that we can look at and break down what they're talking about regarding home price signals in 2025. What is that going to look like for you? And then we're going to talk about a little bit of scuttlebutt. Some stuff that made the rounds on social media over this past weekend that I thought was pretty interesting. There was some misinformation floating around. Imagine that. Misinformation on the internet. Who would have thought, right? Wasn't it Abraham Lincoln who said, be careful what you read on the internet because it might not be true? Haha. See what I did there? Anyway, so some misinformation. And we're going to break that down as well. And I think there's some interesting thoughts about that and the wishful thinking of a lot of people in the market. So we'll talk about that too. So anyhow, let's dig in and let's start with this first article we're going to talk about from Housing Wire. So I'm going to get that pulled up for you here. Mortgages. And this article you can find yourself. It is on Housing Wire. We're looking at this live right now. So this is an article from April 2nd. So fresh, hot off the press type of information. So according to this article, mortgages may be the sunny spot in a cloudy U.S. economy. That's a pretty picture, isn't it? So this is information from the Federal Housing Finance Agency, FHFA. And according to this, it's telling a strong story about the financial strength of this American homeowner that they're talking about. So if you remember, if you've been tracking the real estate market over the last 5 to 10 years, you can definitely say that over the last 5 years specifically, we all know what happened in 2020. COVID happened, and we know what happened to the real estate market when that happened during those years. We saw tremendous amounts of price appreciation. We saw the markets go pretty gangbusters, purchases, sales, all that good stuff. And so we saw that was our post-pandemic boom that they're talking about, that is still shaking out to a degree. And I would agree with this completely, that that's still impacting today, even at 5 years out from when COVID happened. So it's that boom is still dominating, as this says, the average American's financial condition. 40% of homeowners have no mortgage at all, which is a giant number. And I have a guess of who those mortgage holders or who those homeowners could be that don't have mortgages. I believe that there's no data to back this up. This is purely my gut suspicion, is that those folks are boomers. The boomer generation has a lot of those properties that are locked up, paid off. They're in their houses. They don't have a mortgage. And then those who do hold mortgages, according to this, they're in great shape because of many years of consistent appreciation, meaning values increasing. What this article is saying is that the average loan to value, they call that LTV, across all mortgages, outstanding mortgages that are still being paid on every month in the United States, is at 46.9%. That's down from 70% in 2013. So when we say that with loan to value being down, this is a cash cushion. This is a good thing, meaning that if something happens to these homeowners that have these mortgages where they have to sell it, they have to sell their house because they experience a job loss or some other financial situation that it means they have to sell a property to tap equity or to remove obligations from their life. This is going to prevent unfortunate situations because a lot of homeowners have equity. So if they sell their property, they're not going to be upside down and will be able to move on. And so without getting into politics, this is alluding to, hey, if the economy slows down, if we experience anything recessionary in the coming months or years, with new Trump administration policies, which we will not go into. There's a lot to unpack with that. But if you watch the news at all, you know the talk of the tariffs and some of those other things that could be shaking up our economy over the coming months. So if the economy slows and we have job losses and on a broad scale that start to happen, these folks who have a cushion with their loan to value of that degree, even if prices soften or values go down, they still have a cushion. And we still have a limited supply of homes. So we're undersupplied in the entire United States when it comes to actual inventory for people to buy. Then there's some interest, there's some good legs for them to stand on financially if that happens. So that's what this graph is showing right here. And it says here, in fact, 82% of those same mortgage holders have at least 30% equity in their home. So, and that's what I was just saying here. If prices dip, which could happen, we're going to talk about that in 2025, almost no existing homeowners are at risk of being underwater. So at the end of 24, the Federal Housing that administration reported that 0.3% of borrowers have negative equity. So it's such a small amount, those people who are underwater on their homes. 0.3%, so well under 1% of those borrowers have a negative equity. If we compare that to the crash years, 2008 and the years that followed, when we had the big recession, the Great Recession, having lived through that and now looking back at it, those years were completely bananas, right? So if we think about the inverse of this during that time, we were some of the homeowners and borrowers at that time who were dramatically underwater. I think when worst hit the worst, we were probably over $100,000 underwater on our home during those years. And I will remind you, different economic factors happened during those times. We're not going to break into that today, but it's just an interesting thought caveat to this whole conversation about negative equity and what that looks like today. This graph with all these beautiful colors shows the great American cash cushion that is showing these 82% of borrowers that have at least 30% equity in their home. So the negative equity are this kind of turquoise color. If we take that out, you can see how much that changes. So that negative equity, these folks right here, that's a very, very small part of this selection. And then we have this number here in black. So you can see the difference. It's pretty incredible. It's pretty incredible. Also, we still have the golden handcuffs. This is what I call it for a lot of people who own properties that were able to purchase or refinance during the years when we had those super historic, incredible interest rates, right? The things that are under 4% that those lucky folks were able to achieve during those years. So we still have a lot of those out there. They are still dominating the landscape. And it's another advantage for existing homeowners. Their payments are super affordable right now because they got those low interest rates. And according to this, at the end of 2024, 82% of mortgages carried a rate below 6% and over 50%. So 54% of mortgages have a rate under 4%. So those are homes, those people have properties that are exceptionally affordable considering what has happened with interest rates over the last few years. So here's the outstanding mortgages by interest rate. So you can see the percentage down here. There's 22, let's see, right now, Q4 of 2024, about 21%. We're under 3%. Those folks that have their mortgage rates that are so exceptionally low right now. Sorry, someone just came in my studio and made a noise and made me jump. So that is that section. So this is some interesting conclusions that they have here. These ultra low payments carry a lot of weight in an economy that could be slowing. In a lot of these cycles, homeowners who lose their jobs are forced to sell. So again, as I alluded to earlier, if the home is underwater and it's going to take a long time for it to sell, those homes are going to go into foreclosure. That's what we saw in the crash years. The recession pressures, the crash in the market, the loss of values, that is what happened. That's why we had the foreclosures and short sales we did back in that time. But during this cycle, if you lose your job, let's say we enter a slowing economy. If you lose your job, but you're one of the 27 million homeowners in the US with a 2 or 3% loan, then your mortgage payment is cheaper than any alternative. It's cheaper than renting and it's cheaper than downsizing. So those people, they presumably also have a lot of equity. They can tap into it if times get tough. So there's a lot of things where this bright spot in the economy that this article is alluding to, they're giving us so much information here in data. And mortgage delinquency, like, let's talk about that too. I mean, this data is truly proving that it's actually a bright spot in our economy. So the mortgage delinquency is still very low. So severely derogatory. This goes back to 2003. So you have all the way over here, this green, like severely derogatory is in green, meaning they are way late. You could see it peak back in 2009, the Q4 of 2009. But then we get over here. I mean, yeah, it kind of spiked a little bit, dropping down. Then it continues to drop during the years when everything was gangbusters and the market was quite busy. But yeah, we're going up a little bit, but historically, we're still historically low compared to this high. We're almost where you can see right here, just the sheer amount of people who had delinquent mortgages. So very interesting information here. So really focusing on this far right side of the graph is what's important to look at and understand that delinquencies are still very low. Yes, they've gone up over the last several quarters, but we're not seeing anything yet that I'm seeing in this data. Things are still looking strong in that regard. Okay, but I would like to know what you think. What do you think about all this information? I know there's a lot of people who have interesting viewpoints. I'd love to hear what they are. Leave me a comment. Let me know what you think about this data and this information. If you have a conspiracy theory, I'd love to hear that too. Leave it in the comment, and that would be awesome. Okay, so the next article we're going to talk about, so the previous article talking about the economy and a bright spot being that mortgages are a bright spot in the economy right now. Let's talk about home prices, because in that article, it alluded to slowing of price growth in our market. So let's talk about that. Okay, bear with me. Sorry about this. We're doing this sort of live here. Home price signals continue to weaken. Here's the on Housing Wire. Home price signals continue to weaken for 2025. So we had that bright spot. We had the bright spot, but of course, with all the good, there's always a little bit of bad, it seems like, doesn't it? So here's what we're seeing, and this is why price signals might continue to weaken in 2025. This part of this headline says that supply is up to nearly pre-pandemic levels across the country, and demand is still weak. So there's a few things going on with this. We're seeing supply building. I'm going to say that for buyers in the market right now, this is kind of what we've been waiting for a good while. We have been just completely historically low on inventory for a good chunk of the last 5 years in a lot of parts of the country, in a lot of hyper-local pockets. Remember, real estate being hyper-local by nature. You might see higher inventory or more time on market in some areas, and others just sell quickly for asking price, whatever. But overall, we're seeing supply continuing to build. So I think that means that sellers have confidence. Sellers are thinking, hey, we've been in this house that maybe their motivation doesn't work for us right now. Our family is expanding and growing. We need more space, and we're in the 2-bedroom condo, and we need something that's bigger. We need more bedrooms, more living space to accommodate our needs. Or maybe it's the opposite, and somebody needs to downsize because their house is too big. They don't want to care for it or clean it. It's not being used. It's not a good use of space or money at this point in time. So these sellers are entering the market. Presumably, you would think that sellers will become buyers, right? They sell a property, they're going to want to buy something. So I think seeing more sellers hit the market is a good indication. And though the energy behind buyers and demand may not be super strong yet, I think as interest rates start to stabilize, this is my opinion, that people will gather more confidence if we see that rates aren't doing the wild swings, going from 7.25% to 6.5% to 7% to 6.6% to 7.5%. If we can avoid those whiplash rate changes, I really think that that's going to be helpful, because those whiplash changes, they just knock people out of the market pretty much. That it changes their payment pretty dramatically when you have such a giant swing like that. So my hope is that interest rates, if they stabilize, even if they just kind of creep down slowly, that definitely, I think, makes people feel a lot better about a situation. But you tell me, is that helpful to you? Leave me a comment if you see things the same way that I do. So weekly pending home sales rate is above last year at this time. So there are slightly more home sales happening now than last year at this same time. There are more sellers each week, and there are more sales, but the supply side is growing faster than demand. So that's an interesting piece as well. Home price pressures continue to be lower. So supply is up to those pre-pandemic levels, but that demand is still weak. So their prices nationally are a little bit higher over where they were last year at this time. But if this trend is underway, the prices could shift to a negative very soon. So it really just depends. You also have to think flat to maybe slightly negative wouldn't be completely catastrophic. A lot of people who have equity gained double digits in equity in a 2-year period. So there's some normalization happening with this market that I think could be coming. So it's very interesting. And then according to this, of course, as we just talked about, there's some added wrinkles of a slowing economy. And a slowing economy, if we correlate that with interest rates and what the Fed's trying to do, everything that I've come to watch and understand with what the Fed's doing regarding interest rates and watching the economy, the Fed is wanting to see a slower economy. The Fed wants to see employment drop. I don't like to hear about people losing jobs. It's terrible. But that is what the Fed is using as markers to determine if that extra COVID money that is just out there causing all this inflationary pressure in our economy, if that money is going to be chewed up or mopped up or cleaned up, as you would say, with some of these pressures. And so that is what they're going to watch. And if we start to see these indicators happen, then we'll see what those basis point increases will start to come down. as a caveat, remember that basis point decreases don't directly correlate to a direct decrease in mortgage rates. So if the Fed says we're going to drop the basis point by 25.25, it doesn't mean that mortgage rates are coming down that much. So just know that it affects the bond market where mortgages come from, the funds. Sometimes it's baked in the cake. Sometimes it changes things. Sometimes those decreases actually make mortgage rates go up because it really is dependent on how the bond market reacts to what the Fed does up here, how that all kind of trickles down. So this is the takeaway that this article is saying, is that while the headlines have said over the last few years that home sales are down, but prices are climbing, that could switch quickly or soon to home sales are climbing as home prices dip. Buyers have been, and I will say this as an agent who represents buyers and sellers, the folks I've worked with who are buyers they've had a tough slog over the last handful of years. It's been challenging. Affordability is a real concern. And sellers, if buyers can't afford your property, you don't have anybody to sell it to. That makes it harder for you as a seller to sell the property and for you to unlock the equity you have in it. So it's a win if buyers have a more affordable equation. There has to be a balance in the market. It has not been very balanced. And so I think that there's some of these things that will shift that would make things more comfortable across the board for a lot more people. So anyway, let me know what you think about that. I think that's all very interesting and relevant information. There's a lot of talk in the news right now about the tariffs and the Trump administration's policies and how that's going to shape in the economy. So anyway, at any rate, I think it's all very interesting, and we'll definitely be keeping you posted on the news and what's happening recently and lately. All right, so next up, the scuttlebutt, the thing that happened, the misinformation that I want to talk about, because I think it's really interesting. There was some data that came out or that was discussed over the weekend. I think some big name podcasters and some other folks saw this data, and I don't know if they intentionally misrepresented it or didn't read it, but there always seems to be a reason. Maybe there's a greater plan. This is the conspiracy theorist in me coming out. But the bottom line is what it is talking about homeowner delinquency rates are going up, is what the misinformation said. So here's the post. This is on Instagram. This is coming from Housing Wire and Logan Mohtashami. Logan Mohtashami is a great follow. If you like real estate economics, he's a great follow. So this is information. It's posted on Instagram. You can find the Housing Wire page and you can find this information for yourself. So according to this, it says, no, homeowner delinquency rates aren't elevated. So this is the graph that we saw in that article, the bright spot in a cloudy day, those mortgages, right? The first article we talked about. This is the same graph that we just looked at. And it's pointing to that because the misinformation was that some information that was being discussed related to homeowners, but it didn't. It actually related to the delinquencies on multifamily loans. So multifamily property is anything that is 5 units or more. So you figure anything larger than a fourplex. So in Oregon, at least, on our residential sale agreement contracts, you can buy up to 4 units as an owner occupied in that respect with that agreement. But you also have anything that's 5 or more units becomes multifamily apartment complexes and things like that. So it's a different ball game. So this chart that is cited here is actually from Freddie Mac, and you can't really see it. It's kind of hard to see, but if you read this blue, it says Freddie Mac serious delinquency entry or something like that, or report, and then an M, which it's cut off, but it's multifamily data. So as you can see on the far right side of that graph, it's spiking. So those multifamily loans that are commercial loans, and when you get those, they're not structured the same way as a home loan. A lot of times those loans are going to be, you're going to have a higher down payment. Excuse me, the purchase prices are higher, obviously. But then we also are looking at something called a balloon payment, where at a certain point in time in that loan cycle, the seller is going to have to either refinance or pay off the property. Excuse me. I've got a tickle in my throat. What is it? Allergy season? Defeated the tickle for at least the time being. So that's interesting. So anyway, it balloons off. It's got to be paid for. And a lot of these properties, if you look at where these things, where it started to, if you go back and look at the data, people bought these multifamily properties when rates were low. Well, then it's going to balloon, and to refinance, they have to refinance at a higher rate. So I don't know. I don't know enough about it to honestly get into some data. If you're a commercial broker and you're watching this, or you have knowledge, maybe you own these properties, leave me a comment. But my suspicion is a lot of these folks are looking to refinance or did refinance, and they can't. It doesn't pencil for that property anymore that they own. Interest rates are definitely playing a part in all of this. So it is not the folks who own regular single family homes that are on that delinquency report that was going around the internet over the weekend. And then it goes back to this graph, which is a post I think Logan Motoshami also posted. Let me share my screen on this one too. This is the same graph we saw. American mortgages may be the brightest spot in the economy, because remember, we're comparing this to multifamily. Only 0.3% of borrowers are underwater. Now, the caveat to this is I texted briefly with a loan officer today about this, and he said, well, FHA delinquencies are up. So it's not to say that maybe multifamily isn't leading a trend. It could be. I don't have a crystal ball, but if I'm hearing that some of the FHA delinquencies are increasing as well, I mean, that's probably baked into the cake of this information that we saw in this piece right here to this graph. So perhaps the delinquencies on account of the FHA loan, which is typically known as that first-time buyer loan program, if that's already baked into the cake here, and we can presume, an increase here, we might be seeing a little bit more of that. But historically, we're still coming in pretty low, especially when compared to where we were in those crash years. And also, just because those delinquencies are increasing, remember, the conditions that we're in right now, and this is my take on it, is what happened in 2008 and 2009 is not a cookie cutter situation where that's exactly what's going to happen now. Back in those years, our mortgage lending process and rules were definitely not as locked down and buttoned up as they are today. The government's made tons of changes to lending since that time. In a sense, to protect borrowers, but also to not allow for people to buy properties they truly can't afford. So they've made a lot of changes to the lending process out of those recessionary years in 2008 and beyond. So we also were completely oversupplied. There were so many houses on the market. And when the bottom fell out of that market, we had that true bubble of oversupply and crazy money going around all over the place to buy these, and people who shouldn't have been buying houses were buying houses. That is what bust that bubble. That's why we had this giant oversupply. But it's interesting to see that, and again, I don't have a crystal ball. I'm only looking at the best data we have available right now. And my interpretation of it is, in order for us to get to a situation where we had such a gigantic amount of delinquencies and underwater mortgages, I don't know that we'd want to live through that economy that would cause that with today, especially considering the equity position a lot of folks have right now. For that to be completely wiped out by decreasing in price and everything else, that would be terrible across the board. I don't know that that's something we should cheer for or look forward to. I know there's a lot of naysayers out there who talk about this, and they're probably just keyboard warriors and internet trolls, but they come out of the cave once in a while and they'll say stuff like, you know what? We need to have a giant recession. We need to have everything, the bottom fell out of the market. And I'm thinking, your grandma, your mom and dad, your auntie, uncle, whoever, who has paid their house off and or has an equity position, and this is going to feed into their retirement or their care. If that happens and their values are cut 50%, their cost of living probably isn't going to change all that much. Suddenly you've shorted their cash and retirement position. That's going to make things a lot more challenging for them in their golden years and as they retire. So there's a lot wrong with some of those arguments that frustrates me. So that's just my hot take on it. I don't wish for that kind of stress and grief on anybody. And those people who say they're waiting for the bottom to fall out of the market, honestly, you're probably the same people who couldn't buy a house anyway. If you can't buy a house now, or you're not going to, you won't buy a house then either. I don't know. You tell me what you think. You leave me a comment. That's my hot take for the day. Would love to know what you thought about today's show. Leave me a comment. Tell me your thoughts about everything overall. There's some bright spots out here. I don't think any of this information is inherently negative. I think there's a lot of bright spots and a lot of positive things that when we assess the real estate market, or we're talking about going out to the market and making a purchase or selling a property, these are all things right now that can easily be navigated, and is just being smart and paying attention to the market and paying attention to the data and using that information to leverage, or using that information to make smart decisions. Leverage that data and come to the market prepared and in full understanding of what's actually going on in the real estate world today. So anyway, thanks for watching today. I will see you again next week at noon Pacific time for yet another episode of Real Estate Recess. And I'll ask you for a favor again. If you've hung with me this long, I greatly appreciate it. Subscribe, hit the notification bell, share it, share this with your friends. Would love to connect with them too. And also, if you're looking to make a move around Oregon's beautiful, stunning, classy North Willamette Valley and the Portland metro suburbs, I'm your local real estate expert, Jennifer Schurter, and I would love to help you navigate the real estate market and make that move that you need to make. And otherwise, until next time, have a great week. We'll see you soon.